Well, I think the climate story is probably a really good example of this. I think a lot of people, we think it's a very credible story going forward, largely because obviously there's a climate emergency going on right now. But now you have politicians now motivated to make this move of investment into climate because realistically, it's one of the few ways they can spend to create new jobs in this difficult economy. But you compound that with what's going to need to happen in order to facilitate this climate change. And we think the materials sector is going to be a key part of that. And we're seeing that really play through. So a lot of these industrial metals that are key to some of these climate technologies should be beneficiaries. And investors are going to benefit because there's been underinvestment in these sectors for really the better part of a decade.
I'm curious to get your take on the banking sector. In Europe, we have seen renewed appetite for banks amid this rotation into a cyclical value away from growth, but still banks have underperformed when we look at it year to date. How are you thinking about the outlook for this sector? Is there a value opportunity here?
There is a value opportunity, we think, in banks in Europe, but we want to be pretty selective about it. One of the things that we saw in 2020 is that governments and regulators have essentially prevented people from defaulting on their debt. And they're effectively trying to stretch that out. So we think that's something that will be with us for the next couple of years, and that will weigh on especially some of the poorer banks in the system. And so we want to take a quality bias in the banks. We do think that, as we've seen in the UK, there is the prospect that dividends come back for some of the better quality banks, and that can be a catalyst. So we like the banking sector, but we want to be very selective in how we play it into the cyclical recovery.
And certainly there is room for optimism there on the dividends front with the PRA announcement yesterday. Taking it back to what Juliana was talking about regarding thematics for next year, one of the big themes of this year has been the huge amount of IPOs coming out of the US, mainly in the tech space. We saw Airbnb yesterday, an astonishing price action after the shares started trading in secondary market. Do you see parallels between the environment that we're in today versus what happened back in 2000, and that the market is just getting a little bit too frothy here? Or is some of this exuberance justified?
I mean, there is some frothiness in the market, and we wouldn't doubt that. And as a result, we do want to be very selective about how we're choosing our opportunities. But one of the things that we've looked at, if we look back on some of these long secular themes, I think the key message that we leave with investors is identifying these high quality secular themes, sizing positions, and managing risk to allow you to stay involved. I think the difficulty for a lot of investors coming out of 2000 is realistically they got blown out of what were then their speculative internet positions, when now looking back 20 years, just holding through that volatility was the right strategy. And so sizing positions, managing risk will be very key in terms of investing in these transformational opportunities.